Have you ever wondered why any lender would give someone money when they know that there's a high probability that they would not be able to pay that money back? It defies logic, and you're like thinking to yourself, and I know I've had these thoughts running through my mind when I look at the situations that individuals who come to us to get help with their credit, and I look at the loans that they got from some of these subprime lending companies and credit card companies that specialize in giving money to individuals who have less than perfect credit. Like, I'm thinking to myself, why would they even be in this business? Above the water, what they let you see is that, oh, we're going to just charge higher rates. We make the money back because the individuals who do pay, that end up paying, they actually pay for 3 or 4 people who don't pay. And that is the business model that they let you see. But there's a business model that they didn't let you see. And I was always perplexed with in my mind, like, why would they even do this? Why would they even take the risk when you could just go out there and get people who are credit worthy, and then allow those individuals not to get into a bad situation again by getting subprime loans and to work themselves into a good credit status to where they'll be able to get a loan at a reasonable interest rate, reasonable payments. But it seems like there's just a trap that's set for people to have to stay in that subprime category unless they get their mind right and start to, look at doing things a whole total different way. Because there's the payday loan traps. There's the auto title loan traps. Low credit card trap. And that gets into the video that we're going to talk about today. And by the end of this video, I promise you, this is going to be so full circle for you, because it was full circle for me, because I've always wondered why would any lender throw money out on the street like that with individuals who have a high probability of not paying those loans back. Like, it just didn't make sense to me. And I'm just like you, where I was just seeing stuff on the surface, and I would get data in, but I was like, this just does not make sense, because why are these companies participating in subprime lending when subprime lending is very, very risky? But these subprime lenders make a whole bunch of money. So we're going to talk about why they do it. I'm going to bring this full circle. But first, let me give you some backstory. We're going to be doing a deep dive into the world of credit cards and debt collection, focusing on Credit One Bank and its connections to debt collection agencies like Resurgent Capital Services. So you're probably your mind is already knowing where I'm going with this. Credit One Bank, N.A., is a U.S.-based bank specialized in credit cards for individuals with low to fair credit scores, established in 1984 as First National Bank of Marina in California. It rebranded itself Credit One Bank in 2006, and its headquarters moved to Las Vegas, Nevada. The gambling state, right? We're going to gamble. Credit One Bank is wholly owned subsidiary of Credit One Financial Incorporated, which is closely affiliated with Sherman Financial Group, LLC. You see that connection? Sherman Financial Group, LLC. A private equity firm specializing in consumer finance. Ben Navarro, the founder and CEO of Sherman Financial Group, is the controlling stakeholder of Credit One Bank. Resurgent Capital Services is a legitimate debt collection agency that works closely with LVNV Funding, LLC, a company that purchases delinquent or defaulted debt accounts from major banks and lenders. When Credit One Bank charges off debt, it may be sold to Resurgent Capital or to LVNB Funding, which assigns Resurgent Capital services to collect the debt. Some consumers have reported receiving collection notices from Resurgent Capital Services for debt they didn't recognize, allegedly originated from Credit One Bank. So, before I get into the next phase, which is going to bring this whole thing together, is that whenever you receive any type of notification from a debt collector about a debt that was purchased from the original creditor, you need to do a full debt validation on that debt. Regardless if they purchased it from the original creditor, you have a right to do that debt validation, because when they sell that debt, no matter where they buy it from, they are required to maintain certain documents. They're required to have transferred the information accurately. They're required to do a full accounting of the of how they came to that amount. But they don't have to do any of that stuff unless you ask for it. But don't worry, I'm going to get you a document so you can do that. But now let's get back to this here where it goes full circle. I was always wondering, why would these companies get involved in subprime lending? Why would they do this type of stuff when they know that it's a high probability that the individuals that they're giving these credit cards to or loans will not pay the debt? The full circle came to me. The full circle came to me when I looked at the amount of default judgments that are handed down, and I was going from the states that reported, and I was noticing that LVNB Funding, Sherman acquisition through LVNB Funding purchased the debt from either Sherman or from Resurgent. Sometimes Resurgent sued, sometimes LVNB sued. But all of the debt was being funneled down from Credit One Bank. Now, so they know this is part of their business model. They know that if the 75%, but its reports say 75%, I think it's even higher. But let's just go with what's being reported. If 75% of all debt collection lawsuits end up in default judgment, and if you have a default judgment, it allows the debt collector to garnish your wages, garnish your bank account, or seize assets to pay for that debt. What are you following me on what the whole business model is about? If you don't pay the loan off, don't pay the debt back, they end up charging off the debt. They sell it to LVNB Funding, Resurgent Capital. LVNB Funding, Resurgent Capital sues you in court. You don't show up, you don't know what to say, or you show up, still don't know what to say, don't have any defense, no challenge to their case. They end up getting a judgment or a default judgment against you. Then they go and they garnish your wages, which it's going to be an automatic payment that you have to make. There's not going to be any choices that are going to be able to be made. You're going to have to pay it out of your paycheck, because they're going to go to your employer and say, we have this writ of garnishment from the court, and you must take upwards of 25% per paycheck out of this individual's account. Out of this individual's paycheck, and send it to us either weekly, bi-weekly, or monthly, whatever arrangement they put together. This is where it really gets interesting, is that most people who end up getting garnished end up paying more than what the original debt was, plus they end up paying off the debt faster. So let's look at this scenario. If you have a credit card with Credit One Bank and you have a balance of, let's say, a couple of $1,000, and you're paying a minimum payment of, let's say, $25, $30, $50 a month. It could take you years to pay that off, right? But you would have that choice of paying more or paying the minimum or paying more. You would have that choice, and it would be a small payment. Yeah, if you extend it, they're going to make money on the interest, but that's the choice that you can make. And you can pay more if things were going good that month. You could pay more, or you could stick with the minimum payment. You have a lot of control in your hands. When they go and they get that garnishment and they're taking it out of your paycheck, I've seen where individuals are paying 4 times the amount of the minimum payment. So they're actually getting their money. And see, this is the thing. When I started connecting these dots, and they say stuff like Sherman Financial Group, LLC, a private equity firm specializing in consumer finance. So this is where they get the money to front load their investment. Remember, business people are not going to be like, well, I'm going to invest my money and I got to make my money back in a month, or I got to get some results back in a month. No, they make an investment in their business, which is an investment in themselves, because the business doesn't spend the money. The individuals who make the money from what the business does end up spending the money on themselves, making their lifestyles better. So what they do is they say, we're going to invest and we're going to let this mature. Just like anything in life, if you're working on your credit, if you're trying to get out of debt, you're trying to improve yourself health-wise or whatever, it takes time. Nothing is going to happen overnight. So these companies are like, hey, this is the plan. Here's the plan. We're going to put money into these people's hand that would have not gotten approved through the, like Capital One maybe, or Capital One might be doing this same type of thing too. But like Capital One or Chase or American Express, those companies, they're not gonna deal with this group of people who have low credit scores or bad credit. We're gonna give that money. We're gonna, make this private equity firm. We're gonna put all of this money in there, and here's the business plan: is that we're gonna get them the credit cards. The people who end up paying back, fine. We're charging them, 25, 30% interest. So even for the people who don't pay that end up getting charged off, they're helping, keep that boat floating, so to speak. But then the people who do get charged off, we're going to let that build up with interest over those 6 months. What are they going to care? They're not going to do nothing. They're not going to call us. They're not going to do anything. So we're going to charge them fees. We're going to charge all type of stuff because they're not paying anyway, so it doesn't matter. So we're going to just let it just keep ballooning up. So even though they had a $2,000 credit card with us, now it's, $4,000 or $5,000. What does it matter? Whatever we say, they're not going to do anything anyway, because we know that they're not even going to show up to court. They're going to end up getting a default judgment. Why do we know that? Because the records and studies and everything shows that these individuals don't know what to do, don't know what to say, don't know how to put the defense together to even fight back against this. It's not going to matter. So we're going to set up our debt collection company to buy the debt. Sherman is going to buy the debt, and then we're going to sell some to Resurgent. We're going to sell some to LVNB funding. And the reason why we got to have 2 of them is because there's going to be so many. We don't want to put so much work on one debt collection company. We can just divide it up into 2. And so then when we get these default judgments, we're going to actually be getting 4 times the payment, because every time their paycheck is drawn, we're going to get 25% of their pay of their disposable income. So whatever that income is, we're going to get it. And now, instead of waiting 2-3 years to pay off that credit card, they're going to end up paying off that credit card within 6 months, or or even sooner, 13 weeks. It just depends on their income. So you see how that runs full circle. So these people are not dumb. Like what they do, this is what these companies do, is they make it so enticing for people to jump in and get these payday loans, get these types of credit cards. And then I don't want to say that they're hoping that the person doesn't pay. I don't believe that they would do that, but I do believe that they do have a plan. They have a plan already set up for if these amounts of, if whatever amount of the customers end up going in a charge-off status, they already had the plan put together. And also another part of the plan too, is that people don't get a card and just straight up don't pay. That rarely happens. I see people with their credit reports where they'll struggle to pay for years. And then at some point, they're just like, I just can't do it anymore. That's what they end up saying. So these companies really, they make that money on those struggling payments, because this is the cycle. Individual gets the card, they're happy, they feel like this credit card company is trusting them, they're doing them a favor. And I understand how they can have that feeling. They go out there and get them some stuff that they didn't, that maybe they've been wanting to get. Maybe they, trying to get something to make themselves feel good. I've done that before too in the past. And so they get it. They might even pay it off the first time. They're like, I'm going to be good with my credit. I'm going to pay it off. And then all of a sudden they do it again. And then maybe they get another card, or maybe they get, hours get lowered at work, or they have to switch jobs. You just never know. Life just happens. And then all of a sudden they can't make those payments. And it just gets to a point where they're like, I got to make a choice, either to put food on the table or pay this credit card. Guess what they end up doing? And then, and the mindset on that is that I'm just not going to pay them. And it does go away for a while. Like when people stop paying, it's just like, okay, now I can just focus on maintaining the household. I don't got to worry about them. They can't come make me pay it. I went through that. I know how these feelings are, and I know that mindset. I went through it myself. But see, what these companies are doing, they don't go away. They don't go away. They already have the business plan in place. So what they're going to do is they're going to charge off that debt after they balloon up those fees. They're going to pass it off to one of these debt collection companies. And then those debt collection companies are going to take you to court. They take you to court. They get the default judgment because you didn't know what to do, didn't know what to say, didn't know how to say it, didn't know how to defend yourself. And then all of a sudden they get a default judgment, and then they're garnishing 25% of your wages, or they're going and dip it into your bank account, taking all of the money out of there, or they're looking at seizing assets. They can do all three of those. All three of those. So now let's talk about some solutions. Number one, to get yourself out of that situation of being a subprime borrower, is you have to repair your credit. That's the first thing. So what you can do is you can go to my website, thecreditrepairshop.com. You can watch the video of what makes us different. It shows my 8-point validation process, my 2-phase settlement process. That's the way that we repair credit and help increase scores. It goes hand in hand. It is not going to happen overnight. So if you're looking for overnight, you're looking for credit sweeps and all of that, go somewhere else, because we don't do that. We do it the right way. We don't want you to have to look over your shoulder for some surprise that's going to come back to hurt you in the future. When your credit is repaired through us, it's repaired. That part of having bad credit in your life is done and over with. If you need your credit reports and scores so you can know exactly what's going on with your credit, go to the website, the number 3scores.com. Links are below this video. Grab your TransUnion, Equifax, Experian credit reports and all 3 scores. If you have debt collectors coming after you, I'm going to give you 2 options, because you can make a lot of this stuff go away, even though Credit One Bank sells the debt to Resurgent or to Sherman. Sherman sells it to Resurgent. Sherman sells it to LVNV Funding. You got 2 levels of debt collectors, unreliable documents, but you got to know how to challenge those documents. So I'm going to give you 2 ways. The free way, go to my website. Link is below here. There's a link to get my 3-pack of letters: statute of limitations, debt validation, cease and desist. Or you can go the exclusive debt validation. You can grab that letter, go to summonsmaster.com. All you have to do is put your letter in there. It'll create it. All you have to do is sign and date. It will create a debt validation that will challenge every aspect of them buying that debt, even though they're in essence buying it for themselves. But it'll work for any debt collector. It can make most of your debt collections go away. When they sell that debt, it's in a new category. If you have a debt collector who is suing you and you don't know what to do, don't know what to say, don't know how to say it, don't know how to defend yourself, I'm going to show you exactly how to do that by having that document prepared for you, to where all you have to do is show up to court. If you even end up going to court, because most of the time they're going to end up dismissing the case. I want you to go to summonsmaster.com. Link is below this video, summonsmaster.com. So you can, all you have to do is make a PDF file of your summons, upload it in summonsmaster.com. In minutes, it's going to create your response to the court summons and a defense to beat your case. This AI model was trained by me. You can't get this on ChatGPT. You can't get it on any other platform. This comes from my experience of over 5 years of helping my clients get cases dismissed as much as $100,000 from original creditors and debt collectors, from both. Go to summonsmaster.com. Thank you for your time for watching this video. Please subscribe to the channel, post your questions and comments. This is Stephen A. Williams, President and founder of thecreditrepairshop.com. Thank you.